Taylor, I got to get you some props. Once again, you outdid yourself on Instagram. You did a quick 60-second reel on Jeff Gunlock talking about the chances that we are in a recession right now are greater than 50%. I have no idea how you get all of that into a single video, so I thought I'd give you an opportunity to expand it a little bit. Let's talk about what Jeff Gunlock is saying. And what's going on?
Yeah, I think the first thing to realize is that Jeff Gunlock is not one of these perma bears always in a bunker calling for it, gold, saying it's going to the moon, etc. He's just a person that looks at data, ascertains, kind of what he thinks, but he has been an amazing investor over the long term. And he runs Double Line Capital is the firm that he runs. And they've made some historical macro calls on his notes that have led them, to amazing long-term investment returns. And he said that, within the next 2 quarters, we'll have found out that we are currently in a recession to the tune of higher than a 50% probability. And this was on the heels of Jerome Powell's comments. It was the same day that the Fed had met that he came out thereafter and mentioned this. And we discussed the fact that the Fed was the one saying, hey, we've increased our unemployment likelihood by the end of the year, that unemployment goes higher, inflation goes higher by year end, GDP comes down by year end. So Jeff Gunlock's comments are not too dissimilar from what the Federal Reserve is saying to look at in general as well.
Yeah, when I hear guys like, again, I think that was a very important opening about Jeff. He's not a perma bear. I wouldn't put him in that camp. In fact, I like what he does at Double Line. I think he makes some wonderful macro calls. He's a fixed income guy, but I like how he deciphers the economy. And I think what he's looking at is he's basically saying there's 3 legs of the stool to the U.S. economy: government, call it business, private enterprise, and consumers.
Yep.
And I think what he's basically saying is, at least in the short term, government spending down, consumers down, small business down. And he's like, I don't know how that's not a recession. That's what I think he's saying.
Yeah. And I will say that the one that's been bucking the trend, and this was not, again, that Jeff Gunlock's been calling this for years and years. He's not. He's just stepped up and made this comment now. But the one that's really been bucking the trend is the consumer. So, well, I guess, the government has for that matter as well. The government's continuing to inject capital in. We talked about in the last episode that we're going from 7% fiscal deficit spending down to 3%, which is just massive pulling on the reins. Yeah. So the government is going to now leave it up to corporate America's own devices. Can they stand on their own 2 feet? And then to your point of like the consumer being a massive one, consumers have continued to spend in the face of rising interest rates over the past few years. And it's funny, how much impact does rising interest rates have on the consumer, I think, is going to be the case study that people look at this time right now in history and say, do interest rates have the effect they had in the past?
Yeah, it's just really, I respect Jeff Gunlock. I like what he does. I watch everything on CNBC that he's a part of. But as the macro picture plays out, I also think short term and long term, right? When I look at what's going on right now, we talked about in video number 1, kind of the timing lag, right? A recession call makes sense, which I'm not going to do because I've been wrong the last 2 times. I'm just going to say it makes logical sense. But I think it would be short and shallow because coming out of this will eventually be deregulation, tax cuts, these other things, no tax on tips, no tax on Social Security or whatever else is in this new bill coming. I think the second half of the year is much better than the first. So short and shallow recession, does that kind of make sense?
Yeah, I think from an economic standpoint, it does. I look at things from a market standpoint and stocks, bonds, et cetera. And I think that the outlook for stocks right now, and I'll discuss a little bit about this, if we were to enter a recession, is a bleak one. And bleak is probably an understatement as to what it is. But I think your comments are relatively fair in the fact that we're trying to rip this Band-Aid off really quickly. The one thing that we have the ability to directly impact is the government spending. And that is a light switch, right? And I'm probably oversimplifying that to an extent, but we are effectively saying we are reining this in, slashing and burning very, very, very quickly.
Yeah. So let's break that down because you've done some research here recently and actually have an Instagram post on this. So we'll point to folks too. But just how bad, how much pain in the market if a recession occurs?
Yeah, and again, I don't put out these numbers to scare anybody, but when you think about the S&P 500, the price of it is a function of very simply two things. One is earnings per shares by companies, and then the other is the price to earnings multiple. And you literally multiply the two and you get to the end result. So currently, the most recent EPS data that we have for the S&P 500 as of end of Q3 of 2024. So 930 data. And at that point, S&P 500 companies were producing just above $200 worth of earnings, a little less than 201. And what you have is a 28 time multiple on that, which is the price to earnings multiple. So
5,600. Yeah.
Yep. Yeah. So it was 28 and change. It actually wound up being 5,700, but your math is perfect. You're right. So just to give a little context as to when you go into recession. So I looked at the last recessions going back to the Great Depression, and I actually backed out the Great Depression and the Great Financial Crisis to take away the really nasty
the tail risk. Okay.
The absolute tail risk nastiness.
Okay.
So reduction in earnings are about 8.4% for the average. So it's not like there's this bloodbath of earnings just absolutely spiraling.
All right, so let's just keep the math going, right? Let's call it 8% on 200. So you go from 200 to $184 roughly.
Yep, exactly right. So you're at $184. And by the way, if you were to include the Great Financial Crisis and the Great Depression, the average is 18%. But there are obviously massive anomalies that take it down even further. Right. So that's okay. You go from 200 to 183, 184, whatever that number is. Yeah. And that's not a massive downside, to state the obvious.
Okay.
Where the massive downside comes is on the backs of 2 years in a row of 25% growth out of the S&P 500, with earnings not being the driver of all that. A lot of it just being the sentiment and the level of comfort that people have buying these companies have just driven up that multiple. So the trough multiple during the average recession, again, back out the two nasty ones, is 13 times. So and now
28.
28. Now it's trailing earnings, to be clear, not forward earnings.
Right.
So all of a sudden now you take that, multiply it times 13, and you're at a 2,400 level on the S&P.
Because it's more than half.
Yeah, 58% is the reduction in the S&P 500. If you just go to averages, and again, we don't know that a recession's coming, but if a recession does present itself and you just take the average, again, taking out the glaring nastiness of the Great Financial Crisis and the Great Depression, that lands the S&P 500, just taking the average, at 2,400. So I don't say that. Go ahead.
That's wild. And again, this is ex-GFC, ex-Great Depression.
Correct.
You're getting a 50% drop in the S&P 500.
58.
Yeah. Dude, I was rounding to make it a sexy number. Oh.
Well, reality is you round like Jerome Powell in the Fed rounds. Rounds to 50.
How did 58 become 50? I just dropped the 8.
Exactly.
Not really rounding. Oh my
God. Think the reality is like, one, know that is considering that we're going into recession. That is a huge unknown to begin with. But regardless, we're at a price to earnings multiple right now that's at 1.5 standard deviations away from the average, not in a recession, just the average throughout history. So that means that we're more expensive from every dollar we're paying for every dollar worth of earnings. We're paying more than we have 93% of the time throughout history. And that's against the backdrop where people are starting to get nervous about a recession. It's not priced into stocks.
Yeah, regression to the mean is painful, right?
It is. It is. Painful. And so I don't give all that information in the context of like, hey, we're going to see a 60% drawdown. This is doom and gloom. Get out of the way. Yeah. But it is.
It's good to know. It's good to know.
That's the point. It's, hey, if you're building portfolios or if you're investing your own money and you're not aware of this, like you should be. You should be.
Well, let me ask you this. So let's just pretend for a moment. Let's fast forward. It's November 17th. I have no idea why I picked that day. November 17th. And the stock market's down 50%. How many cuts do we have from the Fed at that point?
All the way to zero.
We go right back to zero?
Right back to zero. Would you expect anything different if we have
I was hoping we'd stop at like 2.
No, not at a 50% drawdown in the stock market. Now, granted, what's going to be going on in the backdrop of the economy if it draws a 50% drawdown in the stock market? Like, these things don't happen in a vacuum. We're not, we're not experiencing that without the negative news out of the economy as well.
Yeah, I mean, yeah, because you would have negative GDP, you'd have unemployment rate spike. I mean, it would be
Correct.
It would be a set of dominoes, like others.
But zero. Yeah. To be clear, we will be at zero.
There's no hope that we learned our lesson. We're not going back to zero.
Absolutely not. Absolutely not.
I was hopeful. I just think we got to be done with zero.
Silver lining there is.
Yeah.
If we start issuing new debt at that point, it's not as expensive for our government to pay the interest.
And let's hope our Treasury Secretary this time is smarter to term it out instead of going short.
Again, we talked about that on one of our other videos. Trump's greatest move ever was to say, hey, let's issue 100-year debt.
Yeah.
And we didn't do it.
Let's term it out.
Instead, we like to fund things on the 3-month end of the curve. It's like, come on.
Janet Yellen, you're smarter than that, or I think at least you were supposed to be smarter than that. Yeah. So again,
started Debbie dying on a Monday like that.
Well, no, I mean, I think it's important to realize, because even if a recession is not coming and Jeff Gundlach's wrong, recession will happen, right? They are natural parts of the economy. It's not like we figured out how to never have one again. So it's important for people to know. But I guess the silver lining of this also, not only getting zero rates and all of that, but you can really start building a portfolio at that point.
Yeah. Oh yeah. You can get aggressive at that point. And that's the reality is, like, I think we're in a little bit of a new world order where I don't think that we get resets back to like really nasty price to earnings multiples. I think that you need to be a buyer when things reset down to, and one of the tricky things when you're talking about price to earnings multiples are you looking at forward or rear view mirror ones, whatever. Most people talk about forward. We just talked about rear view mirror with everything I gave there for the record. Right. But on a forward multiple earning, where we're at about 21 times earnings right now, okay, you need to get regression to see real value in the market. And I think when it gets down at 18, 17 times, I don't think you get down to historic averages at that 15, 16 times. I think you have to be a buyer in the market ahead of that, because I just think that companies are more efficient. They're better moats around these big businesses.
Yeah,
et cetera.
I also think we just have so much freaking cash in the system.
Totally.
We still have all that freaking COVID cash sloshing around. So I think an 18 kind of feels like a 15.
Yeah, I think you're right. And I think that also you have massive money sitting on the sidelines in money markets. There's nearly $7 trillion.
7? Oh, I thought it was 9 trillion. 7. I mean, whatever. It has a T on it.
Right. Regardless, it's massive. And so I think some of that money starts to, and I say that actually, we should be smarter than this, knowing the psychology of human beings, that if it gets nasty, that's not coming out.
Yeah. Well, let's be clear. Some of us will deploy it because I don't want my cash earning zero. Dude, if we go back to zero.
But probably what will happen for the masses is you'll get that drawdown. You'll be down at 17 or 18 times earnings, and people will be scared to death, and they won't want to put money to work, and it'll go back to 20 times, and then they'll re-enter at 20 times because it's
well, what I'll do when rates go to zero again is I'll refinance all my properties. I'll cash out, I don't know, 5, 6, 7, 8 million bucks, and I'll just go shopping. That's what I'll do.
I love it. I love it. Yeah. And you think about it, like what happens to the real estate market in that environment, even with a dearth of supply. Like we talk to people all the time. One of the values of having a truly diversified portfolio is people say, hey, I'm willing to weather any storm and I'll sit in the market and, just ride it out over the long term. And then we say like, hey, yeah, but do you ever think about buying real estate? Because that's always in the back of a lot of wealthy people's minds. And they're like, yeah, absolutely. I'm like, well, guess what? When do you need that dry powder? When the market's humming? No, you need that dry powder when it's nasty. So you need to protect some against that downside. Yeah. So you're not selling things that are down 30% to buy that property.
Yeah, exactly. This is going to be a lot of fun. I appreciate the education. Again, folks, give him a follow on Instagram. I have no idea how he does all in 60 seconds. Where can they find it?
Yeah, find it at Life Goal Investments on Instagram, TikTok. I'm on LinkedIn. Find me anywhere.
Thank you, buddy.